This is a podcast produced for EIS Platforms Limited, trading as Growth Invest. It is not intended to be a financial promotion of any sort and is intended for financial professionals only. Any comments made or opinions expressed in this podcast should not be construed as investment advice or a financial promotion. Startups and early stage businesses are high-risk investments and you are unlikely to be protected if something goes wrong. Don't invest unless you're prepared to lose all your money.
Hello and welcome to the Alternative Thinking Podcast with me, Melissa Griffiths. This is the podcast that takes a deeper dive into the alternative marketplace and explores topical issues. We're delighted to have back today on the podcast Simon French, Chief Economist and Head of Research at Panmure Liberum, and Kallum Pickering, Chief Economist at Peel Hunt, for our regular quarterly podcast series. Lovely to see you both.
Really nice good to be here.
So I think initially start with the global sort of economy and what your thoughts are from both of you. Who wants to start?
Go on, Callum.
I can. Let me
set
start.
The scene for us.
Let's set the scene. So, if we were thinking about this, say 2 or 3 months ago, just after the wave of Trump tariffs, we would be concerned about a significant bout of U.S. inflation, potentially a U.S. recession, more weakness in Europe, and probably weakness in China too, with a question mark about whether the Fed would be able to step in time in case things started to look a little bit soft. I think that was broadly the consensus view. Most economists were somewhere around there. I was less about the recession on the US, but a bit more about this might be an inflationary problem. It may make things difficult for the Fed. Now, where are we today? The picture is different in several ways. The first thing is the US economy has been more resilient, and this is just a repeated pattern, not just in the US, but that we've seen around the world. Whenever we've seen big shocks, things have just been a bit less bad than expected. Over the course of summer, the Fed has been puzzling, will we shift further away from our employment mandate or our inflation mandate? That ultimately decides whether the Fed can cut. Yep. That question's basically been answered now. There's a bit of inflation coming through in the US, but probably less than feared. But there's now some clear evidence that the US labor market is weakening. So the Fed is basically on a cutting path. Yep. Be very surprised if they don't just cut in successive meetings for the next few.
And they are thinking, aren't they? They're thinking 2 more cuts, I think, across the
market.
Market
Thinks 2 more before year end, even though Powell is still a little bit circumspect. Now, in China, actually, the situation has surprised to the upside decidedly. Trade especially has been strong. Domestic economic activity's been okay. And I think part of this actually may just be a strong desire by policymakers in China just to demonstrate that the US is not able to inflict pain on our economy. Of course, you have to be a little bit careful with the data, but if you look at consensus expectations for growth this year, they were revised down a little bit after the tariffs, and they've just been revised up considerably. Okay. Of course, partly it helps that the US recession risk is under control for now. Europe's where things get a little bit more interesting. Europe still looks fairly weak in France and Germany. Partly in France, that's a political story, but partly in Germany, it's that earlier expectations that a big fiscal expansion would boost domestic activity, especially industry, has not been forthcoming. You see this continued deindustrialization across Germany, and you don't get the strength in services. That's where the UK looks different. We share the European story where industry and exports are weak, which is due to long-standing issues, energy, regulation, more than it is the US trade policy. But in the UK, actually, the domestic story is still one of resilience. All the growth this year has basically come from an expansion at home. Exports have been weak. Production has been weak. It's not a feel-good expansion in the UK. But all of this basically amounts to, and this is what comes after the equal sign, a continued narrowing of the transatlantic growth gap, which was the biggest in 2023. US growth nearly 3%, Europe virtually 0. Last year, a bit less growth in America, but still strong. We got something like 1%. And then this year, both the US and Eurozone in the UK are going to be somewhere around the mid-ones. And then let's see what happens afterwards.
So Callum's done a really good job of going around the world. That wasn't me using weasel words. It was brilliant. But what is the thematic that if you like, will dictate what happens next. For me, and I think you can pick your geography of how this is playing out, but it's the degree to which institutions matter, because we are seeing challenges to a lot of the institutional framework, not just in economics, but in geopolitics, in society at the moment, be it NATO, be it the independence of the Federal Reserve, be it the role of the UN. A lot of these institutions, I mean, close to home, we'll maybe come on to this in the UK, the role of the OBR, the Bank of England, in the sort of macroeconomic framework. And at the moment, investors looking at public markets where valuations and indices are very close, if not at all-time highs, and in private markets where valuations are also very extended, it appears like investors have concluded that this erosion, which I think we can all conclude is happening, we can debate the scale and the wisdom of it, but they've concluded it doesn't really matter for growth, and that is something of a decoupling of the consensus of perhaps the last 30, 40 years, where more institutions, more frameworks, more cooperation had been seen as a great enabler of productivity, efficiency and growth. And yet that erosion doesn't appear to have been priced into markets as creating a negative outcome. And I think Kallum, a piece he wrote earlier in the year about particularly the US economy sort of muddling through the institutional challenges of trade tariffs, has aged pretty well. Financial markets have responded positively to that scene of muddling through. The question, I think, on everybody's lips, certainly the investors I speak to, is, well, do some of the damage, the damage to efficiency, some of the damage to credibility, come with a time lag? And actually, you get the change here, but actually the response in terms of margins, independence, credible policy making comes later. And we just go, it hasn't happened immediately after events like Liberation Day or events, geopolitical events, but actually they're being stored up for us.
So you think it could be a lag time coming?
Well, you're asking for my view. I think it would be quite something if we built all this architecture of multinational cooperation and it has no value. So actually eroding it and removing it is costless. That feels to me like quite a brave judgment to make. So I think there will be damage. It is the degree to which you can move to a more unilateral stance, a more politically driven approach to macroeconomic policy levers, either on the fiscal side or the monetary side, and where that damage emerges.
There's a bit of a Chesterton's fence argument there, isn't there? You've heard of this.
Well, you're going to have to explain that.
But it's kind of philosophical idea that Chesterton's fence. So you buy a property, you explore the lands, and on your walk, it's a great walk, but you're inconvenienced consistently by all of these walls and fences. Now, this is an old property. You don't know why they're there, but you just know that it's spoiling your walk. And so to make things easy, you knock all the fences down and all of the walls, and then you find out down the line they were keeping the monsters at bay. And I think this is.
I like that.
I'm
going to steal that.
Yeah, but no. but I think this is one way to think about this, and I agree. If you look at like pure risk markets, equities, for instance, or economic performance, you don't see this damage yet. But in other ways, you see in the long end of the curve, or you look at the gold price and you say, well, actually, there's some hedging or there's some pricing of risk. And then the other thing, just really stepping back, like the historical lesson here would be to say, when you are faced with really serious structural challenges, Western economies that have done well are typically those that have strengthened their institutions and opened up their markets. That's antithetical to what you now see unfolding in the US. I think this is really important. And this is where the Trump phenomena, for instance, is very different from the Brexit phenomena. With Brexit, you can say with a straight face that was about strengthening British institutions, which had been weakened as part of a trade-off to participate more widely in Europe. And then you can make a nice joke to say, well, judging Brexit on the first 10 years is like judging Henry VIII's marriage record as the consequence of the Reformation. Like, come back in 50 years and you'll find out what Brexit means. Trump is not like that. There's a desire by both sides in America to not just shift institutions around, but in many respects destroy them. And America is still a very, very young country. It's not got a long history of Reformation, things get better, Reformation, things get better. And South America is just a case in point here of countries that close their borders and damage their institutions paid a huge economic price for it in the long run. And so I think there's a slight oddity here, which is, at the face of it, Europe is doing worse than America economically and markets-wise. But America, and particularly the UK, is taking some subtle steps to try and open markets up and strengthen institutions. America is going the other way. And I don't think the short-run evidence is a good guide to the long-run consequences of this. And there are prominent US historians that are basically making the same argument that, the behavior that you see now in the US from both sides is not the thing that keeps the US as the global hegemon. It would be breaking the historical trend for this isolationism to be a long-run success. Yeah.
And do you then think, so sort of going forward, what's your sort of outlook in terms of globally? Do you see Europe becoming in a better position, really, and the US being very much?
Let me leave this to Simon, but I'll just add something that Larry Summers said a few weeks ago. I think he was speaking to the Scottish historian Niall Ferguson, and he said, I sincerely hope, and I think this is probably the view of most economists, that when the history books are written, Russia, Ukraine, Trump, Brexit, the Middle East, of all of these things will be the third, fourth, fifth paragraphs. The top paragraphs will be the technological transformation that comes from AI that makes all our lives better.
Right.
Like, when we look back, that will be the thing that's unfolding now, and we've sort of got the growing pains of a kind of adolescence more than kind of the arthritic pains of old age. That, I think, is the way I hope things play out.
So a couple of things to add to that. First of all, I think on a multi-decade view, the Ukraine-Russia war is probably the best thing that's happened for Europe in terms of its economic pathway. Right. The decision to obviate responsibility for your own defence for 30 years after the Cold War came down has had an economic blowback in terms of the lineage between defence development, technology and consumer tech, the high-value companies we see on the US, largely the US stock market. Europe, as a result of Russia-Ukraine, is having to pump prime its defence industry, and there's some quite significant ramp-ups both happening and will happen in the future. The spillover into consumer tech won't happen quickly, but it will happen. Yeah. Pretty confident of that. And building something, platforms, globally relevant platforms that can compete with the US in terms of harvesting economic value is probably the most interesting thing for investors. It wouldn't change your asset allocation, certainly not in the public markets right now, but it probably will on a multi-decade view, and that's probably the silver lining to what, in a sort of geopolitical sense, is a very, very dark cloud. So my outlook in that regard, structurally, is that out of these geopolitical events is the economic recovery coming for Europe. But we won't see it quickly in the earnings data or the GDP data.
Are you confident Europe will actually go down the right path with this? It'll
make the right decision. I think Churchill said this about the US. I mean, you're the better historian, far better historian than I. The US makes the right decision after exhausting all other options. You could probably update that 80 years on and say that Europe will end up making the right decisions, having exhausted all other options to try and retain items of public spending that have been built up in more benign interest rate times, in more benign geopolitical times, and transfer those proportions of GDP towards defence. You're seeing that happen in Germany. You will see that happen in the UK. You will see that happen in France. It will not be a painless journey, and it will probably require some quite considerable amplification of the business cycle. I mean, one of the things I wanted to talk about is the fact that we've become used to ending the economic cycle. We've inoculated the business cycle through exceptional deficits that no longer, and you mentioned I think about 5 minutes ago, the signals from the bond market, from gold, they're uncomfortable with that deficit. That will be sending signals about the sustainability of public spending, but there's also within that envelope the rotation towards defence spending, which I think, governments in Europe are going to be sort of dragged in that direction. Maybe not Poland. Poland have already gone there voluntarily, but Germany, France, UK, Italy are going to go there, and it will have a nice positive economic blowback.
So I definitely agree. We're going to have to in Europe go through a very bitter period of economic adjustment where we reallocate huge parts of the capital stock and labour to more productive uses.
Yeah.
And the outgrowth and the bloated public states that we have been the source of a lot of that misallocation of resources, and that needs to be unwound. And as you say, I mean, that's a painful process. Where I'm cautious on Europe is that I'm concerned that the institution, the European Union, that was introduced by design to defang European nationalism, perhaps is not the right institution to put Europe on an appropriate defence footing. Right. And institutions try to preserve themselves at all costs. And I just note that for Poland, Britain, France, which have actually in the recent foreign policy context have probably been the three outperformers in Europe, they are among the least afraid countries in the big countries in Europe of exhibiting national pride on the world stage. See, in America, nationalism is a positive thing. France has a great sense of national pride. That's not true for major parts of continental Europe, and the EU has always been Germany would be a point in case there. We're part of the EU. We'll express our foreign policy views via the EU. Yeah. It's a self-imposed straitjacket. That's exactly right. And so, how do you put the teeth back into Europe with the institution that was there to pull the teeth in the first place?
Yeah.
That's going to be a generational change, and that's where again, in the long run, I think this will be forced upon us by markets, but it's not obvious that you make the right decisions. I think if we can just go into some of the issues that Simon just mentioned. So the first thing I'd just point out is the uneasy fears around inflation that we have in the UK, but basically around the world, are a symptom of the bad policy choices we've made. Just like poor lifestyle choices lead to inflammation in the body, poor policy choices lead to inflation in an economy. This is a signal that the supply side is impaired. And of course, the UK has some special circumstances because of the nature of our bond market and some recent policy mistakes. But around the advanced world, all major economies, as the population ages, are, on current projections, likely to see a 2 to 3 even higher order increase in debt to GDP levels. And this is happening at the time when the bond market doesn't really want to give economies a break. And just because we're not facing an immediate crisis doesn't mean that these interest rates that prevail around the advanced world are not causing economic problems.
Yep.
They're causing crowding out and various other things. And I think the danger is, and this is why governments around the world and opposition parties are so afraid to tackle this head on and say we've made some promises we just can't keep, is they think that if they were to bring spending under control, it would cause recessions. I think there's a very persuasive argument to say if you deal with the long-term debt issuance, what you would do is you would get the confidence back of markets, you would bring rates down, and you would see some immediate private sector benefits, which would ease some of the short-run issues you have with budgets.
Given this is an investing podcast, I mean, it's important to pick up on these points and take the positive messages the market price signals give to investors. I would suggest that some of the failures of allocation that have taken place, I'm most familiar with them in the UK, but they've taken place around the world, is when price signals have been disrupted. And I think the price signals from the bond market are really important signals for government in terms of getting their house in order. But also, and this perhaps slightly pushes back on the idea that Europe won't evolve and reprofile its allocation of capital. Look how the ESG debate has changed for investors in the last 3-4 years since the start of the Ukraine war. I get lots of stuff wrong. It's an occupational hazard of being an economist. But one of the things I wrote about before the Ukraine war was the fact that the ESG needed to evolve to be a bit more pragmatic. It needed to be ESG 2.0, less evangelical about defence, about energy. One of the really positive things, and I'd be interested in Kallum's view, he talks to a lot of investors as I do, is that pretty rapid, actually, rotation towards pragmatism in approaching ESG. Still priorities of corporate governance and environmental sustainability, but recognising we live in a dangerous world and a world where banning the allocation of capital to things that have an inherent utility in keeping us safe, keeping us warm, keeping us healthy, defence, food, energy. We have evolved pretty quickly in public markets and indeed in private markets to reallocating capital in a more sensible way than existed in the immediate aftermath of the pandemic, where it was probably peak ESG. That's a really good signal, actually, because that friction, that stubbornness, that sclerosis that had emerged because of a very, as I say, evangelical approach to ESG has moved on. That gives me encouragement that markets and price signals can facilitate some of that rotation in the allocation of capital, both in the public realm, public markets, but also how public sectors allocate their balance sheets.
So I think there's, without making too much of an academic point, it's important to note that the private economy, the free market, is not a system. It has no designer. It's an adaptation. And this, and the reason why it works is, to Simon's point, prices send signals that contain information about where you should allocate scarce labor and scarce capital. And the high prices that we see in things like energy are not the problem. They're a symptom of the problem, which is we have a shortage. 100%. But they're also the solution. If you just let the market be, investors will seek to generate profits from those high prices, and the problem will be resolved. So wherever you have high prices, in a way, the policy solution is obvious. Just let the market be. But the reason I come at it from this point is just to make something which I think is a point that is not often made, which is people want to breathe cleaner air. They want to live longer lives. They want to live in more security. They want to learn more. They want to have access to better, safer information. Of course, there are instances, like life is full of vices, but on the whole, people desire to have a better standard of living. And that manifests in the market if you leave it be. Where you run into trouble is to presume what I strongly believe is a kind of naive view that profit-seeking and markets are degenerative and exploitative and all of these other things. When you adapt that view, then you require a heavy-handed approach through things like ESG to make the world better. But then in the end, you realize that the world has changed. This ESG system that you've built is not quite right. And then the market is just forced to adapt. And of course, now the adjustment is so painful and it's so long-standing. if we were to run the thought experiment and say, suppose we would have just let markets, well-regulated markets, but markets do their thing, in the end we would have had cleaner energy at an acceptable price, and we would have had more of it. Cars would have become safer. We would have got battery technology that was more efficient. We would have more security in lots of different realms. And the price we would have paid would have been smaller.
Yeah.
This is always the challenge. It's to persuade policymakers that actually in the end, and let me just give you kind of it's a cynical point, but I think it makes it right. The market is a mechanism through which you can distill our collective wisdom. This is a country of 70 million people. Even if you had 650 super geniuses in Parliament, if they control the economy, they are
take just one, Kallum.
Right. Take just
Sorry.
We're not getting political.
But they are imposing ignorance on the genius of the market.
Yes.
You could have 70 million not geniuses. Be careful there. But you're still running into this problem that where you try to design the market, it fails, it backfires. It's why pro-employment policies lead to a rise in unemployment. It's why growth policies tend to be anti-growth. The market spits it back out, and then in the end you have to go with the market anyway. And so I think we're just at the start of this very bitter period where you actually learn, markets figure it out in the end. Light regulation, let people pursue their own interests, let prices adjust a little bit. America's been less badly behaved in this respect, which is why its economy is a little bit stronger, but it's still badly behaved. It still is part of a bitter period too.
Which I was going to say is going to lead us nicely on to what you think about the UK, both of you. And sort of, obviously, we've got a lot coming in terms of, we've got the budget at the end of November. Thoughts on...
Simon, you do the UK since I did the world, and then I'll make a joke of it.
Simon, I know you talk about the doom loop.
Yes. Where to start with the UK economic picture? I mean, the first thing to say is that if I have one overarching frustration with the way the UK economy is spoken about, is the idea that we are facing the economic challenges that have been described, including by myself, as a doom loop. We are approaching them alone. We're not. They are common problems to almost all developed economies. I think Kallum described it earlier as sclerosis of ageing, and there is a degree of that from an ageing population, putting pressure on public finances, putting pressure on intergenerational equality, asset ownership, asset prices. And therefore, my frustration is sometimes, and this is partly driven by our press, although they can't pin the blame entirely at their door, is that we look at it from a rather parochial lens. We don't look just across the channel, maybe at France, in the US, around the world, where similar challenges of an aging population, public policy designed in a very different financing environment of quantitative easing and low interest rates, and now quantitative tapering and higher interest rates. The UK's doom loop is partly of its own making, some rather short-sighted political choices by the new government, amplifying some pretty poor choices, it has to be said, by the previous government, but also to try and be even-handed. Sometimes I hope painfully even-handed, is we get the politicians we deserve. Those 650 are only doing what the general public want. We inherently, as a 70 million population in the UK, we're cakeist. We want a high quality of public services, and we want low taxation. Well, I'm sorry, it doesn't work like that.
No.
So, bringing that all together, what does that mean for the upcoming budget? It means we've got ourselves in another situation where fiscal remediation, so changes to tax and spending, seems to be required to stay within the fiscal rules that this government have set themselves, which the market takes as a signal of discipline. at a time when the market is challenging that discipline by signalling at particularly the long end of the UK gilt curve, that is uncomfortable with the trajectory of borrowing and the level of debt. Do I think it's particularly good to be tweaking your fiscal policy on a 6-month basis? No, because the private sector, let's move away from the public sector, the private sector struggles to get its momentum, struggles to commit to consumption, big ticket item purchases, investment. And therefore, perhaps, there is a payoff of some, which I don't pretend are not difficult political decisions on things like the triple lock pension, on things like the current tax lock on income tax, national insurance and VAT. There are some payoffs of making those difficult decisions in the clarity it gives to what is a pretty healthy balance sheet position of the UK household sector, which is the workhorse of the UK economy, consumption spending.
Yep.
Households have, at aggregate, not in micro level, there are plenty of households that are struggling, but at aggregate, pretty decent balance sheet positions.
So
and
spending
the
power.
opportunity to remove, you described the doom loop, and get something more of a virtuous loop going of consumption spending, fueling business confidence and investment.
Yep.
There is the prize that is within reach,
Yeah.
but actually a successive set of decisions around fiscal events since the pandemic have rather masked that, but it still exists.
Yeah. Thoughts, Callum?
Now the joke, Callum. Come on.
Well, so no, the joke is, you say you go to an investor meeting and you say, okay, so the UK's had the fastest growth in the G7 in the first half of the year. We've had 3 rate cuts from the Bank of England. Sterling has appreciated 10% against the dollar.
Yeah.
UK equities at an all-time high. How do you feel? Bloody terrible. Right? This is the situation that we're in. And now I think there's a fundamental problem, which is policy is now the biggest headwind on the UK.
Right.
Without question, fiscal policy.
Yep.
If you go through the private sector, Simon laid it out, but I would expand even beyond households. So UK banks, 3.5 times more Tier 1 capital than in 2006. Consumer credit at a 30-year low, mortgages at a 20-year low, elevated savings. UK businesses, non-financials, cash levels, 20% of GDP, highest they've ever been.
Yep.
Corporate debt at a 30-year low. We have 2 phenomena ongoing. One is a high degree of precaution, because for 10 years the UK plus the world has just been a very unusual place. So we just have this cautionary aspect to behaviour. That's expected. Probably there's a bit of policy in there as well from the Bank of England. But then there's this other fiscal element, which is every 6 months we face these event horizon risks, which induce saving, they induce balance sheet de-risking. The anticipation that taxes will go up leads to more retained earnings by businesses and higher savings. And the government straining itself to finance debts that it cannot afford is pushing up benchmark interest rates and crowding out activity in the private sector. And so what you really need from fiscal policy is to balance the books in a way that doesn't add further distortions through the tax system, gains the confidence of markets, and then drives down interest rates. And I'll say what this is. This is expansionary austerity. There are some instances where fiscal discipline generates a positive private sector response.
Agreed.
After the financial crisis, that was not the time, because the private sector couldn't borrow more.
No.
But when the private sector can borrow more and wants to borrow more, the UK economy, the reason we have the inflation, the private sector is like an untrained dog. It's dragging you down the road. That's the demand strength that we have, and why the Bank of England is so cautious with rates. The government steps back, drives rates down, and then the private economy takes off. We should get into the politics of what's likely. But I think the most sensible decision the government could make heading into this budget would be 2 decisions. First, just go to once-a-year fiscal announcements.
Right.
But revisit the issue of welfare. It's 25%, is that right, of government spending? It's about 300 billion.
Mm-hmm.
You could cut a big enough chunk from that to generate all the headroom you need to solve whatever gap you might have got. And you'll probably find that if you do it with a scalpel
Yeah.
You can reset incentives, especially for young people, to increase their participation in the labour market. And so then you can raise taxes too. And the market would see that by avoiding anti-growth tax measures, by trying to bring spending under control, you're not only balancing the books, but you're rebuilding the credibility in markets. So bond traders talk of this more on premium, which is to say, why is the UK paying the highest borrowing costs in the G7 when you have the second fastest growth, the second lowest debt, and over a 3-year view, the second lowest deficit? One argument is just to say, well, the UK bond market's less liquid. We don't have the dollar, we don't have the hard currency euro, you're just going to pay more. My argument would be, in the end, those are the facts of life for the UK. So we have to be better behaved in order to keep our bond yields down. Fine. But we're not short of opportunities to do that. What we lack is the political courage.
Can I pick up on that
Please.
political courage point? So Jean-Claude Juncker is a man I think still comes out with the best quote I know about public policy, which is, we all know what to do, we just don't know how to do it and get re-elected. I don't know how many bottles of claret he'd had when he uttered those words, but they are very, very salient. And sometimes I get frustrated speaking to investors who say, well, they need better advisors in government. They need to, who are these people advising them? If there's anybody watching this, listening to this in government, they will know that advice is not the issue. The issue is the electorate are not prepared at the moment to be told the truth about living within your means. And they will continue to pivot their support to those who kick the can down the road. And look, we're making this recording on the morning after an opinion poll that suggests that Reform will sweep the board at the next general election, get 400 plus seats, the Conservatives and Labour broadly getting wiped out. Now, there's lots of the stuff the Reform talk about which I think has economic virtue, but as things stand with their economic plans, this is not making the issues, the signals, the price signals we're getting from the bond market. It's not taking them seriously, honestly. There is more borrowing under those plans. Sterling and the UK should be grabbing quite a significant part of that wallet.
The opportunity, really, yeah.
And yet, the political path that doesn't undermine that, for investors who've seen Brexit, who've seen the response to the pandemic, who've seen the mini budget, have seen the response to the 2024 election, going, I'm rather fatigued. I mean, you talk about consumer being fatigued. International investors going, I buy the valuation story. I like the UK. It's got lots of inherent advantages, which I want to increase my wallet size to that.
There's arbitrage on wages for UK companies, which is just incredible. Like skilled labour force paying 60% what it costs in the US.
And yet, amidst all of that, the political path to saying, let's leverage all these opportunities and return the UK to its, again, a history here of its strength in the world economy as a platform, as an intermediary between the great powers of the East and the West, of a conduit for capital, being very, very open. We appear to be wanting ever to sort of close off on that probably the most time-enduring comparative advantage the UK has from an economic standpoint.
Simon has this nice chart, and you see the UK 10-year basically in the middle of the pack in the G7 until late 2022 after the trust budget, and we leap out. We're now out of sample, and we've not come back in, and we need active credibility-enhancing policy measures to bring us back into sample. Just on this point, and tell me if you think I'm wrong here, I don't think welfare cuts done right would be unpopular with the public. I think they're unpopular with a chunk of the Labour Party that Keir Starmer has not properly addressed.
I'd agree. And actually, the
bigger problem is welfare, pensions and NHS.
Well,
I mean, that's a completely different story.
There's a couple of things. Okay, a little bit into the sort of detail of those 2 points, and how, because sometimes podcast recordings like this, it's a jawboning, just elegantly describing the issue and not suggesting practical solutions. One very practical solution to some of the bond market worries about the long-term trajectory for UK borrowing would be to bring the triple lock that indexes the state pension, into scope of the current pensions review, Pensions Commission. The Pensions Commission should be looking at the long-term affordability of the state pension. And yet, for political reasons, we've signalled the entity that 20 years ago, the original Pensions Commission, actually generated one of the really positive reforms for UK capital markets, for UK pension savings, sustainability of household finances, which was auto-enrolment, workplace pensions. That same structure, the Pensions Commission, could now look at the most preeminent fiscal challenge facing the UK, which is the affordability of the triple lock. And yet, for political reasons, this government's decided not to do it. Yeah. If you U-turned on that and said, we're going to give to an independent entity, the Pensions Commission, the ability to put together the evidence case on the affordability of the triple lock, the bond market would see that as a signal and a road towards a more sustainable long-term public finances in the UK, and would reward the UK government. Exactly. I'm pretty confident of this. Reward by removing some of that moron premium that we see in gilts. Yep. That's a very practical measure. It doesn't cost you anything. It costs you a bit of political capital perhaps, but it doesn't cost you anything to do it. Sends a really important message.
You gain that political capital back by better economic growth over the next 3 years.
100%. And very briefly on welfare, actually, to be fair to the government, I think the reshuffle they performed about a month ago, taking Pat McFadden, who I think is one of the more credible cabinet ministers, out of the Cabinet Office, put him into DWP to look again at welfare reform. I think that is the government saying we do have to look at this, and we're going to have to look at this again in future fiscal events. What the quantum is, I think that will be determined by the Stephen Timms review of personal independence payments, which is the big element that has grown very fast. But again, I've started to sense that actually investors acknowledge that the government will look again at this and is not off the table for the rest of the Parliament, which again is encouraging for the perspective of growth that is driven by less concern over the long-term borrowing costs of the UK.
We just need to avoid another patchwork of anti-growth tax measures. But just on the triple, the reason why the bond market would see this as such a positive decision is this is one of the many inflationary fiscal policies that we have. We embed inflation through the fiscal lock because as the share of non-participants, basically retirees, rises, you have a greater share of the economy that isn't adding to supply, and yet you are saying we are going to maintain their demand growth at the rate that the productive part of the economy is growing. I mean, this is an inflationary policy.
This is why Kallum's so good, because he takes the issue and talks you through the sort of transmission of how that translates from the policy decision through to inflation and the thing that impacts investors' perceptions of interest rates, inflation, the cost of living. I mean, I thought that was really elegantly described.
But thank you, mate. But the frustration here is that in June and July, Labour tried to address this welfare issue, which they had essentially factored into their previous plans. The Conservatives didn't back them. I thought the politics suited the Conservatives to actually back them on this because it would have divided the Labour Party. And I think the Conservatives need to remember they're not in opposition. A bad economy is not good for the Conservatives. It's good for reform. But now the Conservatives have come out and said, we'll actually help Keir Starmer. Kemi Badenoch in his speech said, we will put our MPs on a 3-line whip to back Labour on any welfare reforms. But then when asked, would you be in favour of dropping the triple lock? The answer is no. And so you mentioned cakeism earlier. I mean, this is just one of those perfect examples.
This is Gattoism, isn't it?
This is exactly. This is an Iceland special. You really, really have serious problems here when the left refuse to say, actually, we're in favour of socialist policies, and the right are afraid to say that we're in favour of free markets and capitalism. And so you just have this completely muddled debate by design, and it's because politicians, for now, are rewarded for the reason that Simon said, kicking the can, speak out of both sides of their mouth, and eventually the bond market will just say it's time to get serious. And what will happen is the economy will improve the moment we get serious. I just hope we elect to do it before the bond market forces us to.
Well, as always, I think we could chat on and on, but it's been absolutely brilliant. We're going to all get back together, hopefully with Steve, in Q1, and we can see what your thoughts are after the budget as well. So lovely to have you both. Thank you.
Thanks,
Thank you.
Thank you. To hear more, tune in to either YouTube on video or all good podcast channels.
This is a podcast produced for EIS Platforms Limited Trading as Growth Invest. It is not intended to be a financial promotion of any sort and is intended for financial professionals only. Any comments made or opinions expressed in this podcast should not be construed as investment advice or a financial promotion. Startups and early stage businesses are high-risk investments and you are unlikely to be protected if something goes wrong. Don't invest unless you're prepared to lose all your money.